Today, we're doing a deep dive, a full financial and operational analysis of BWX Technologies, Inc. This is a company that really sits at a fascinating intersection of defense, nuclear energy, and very advanced manufacturing. It's a specialty manufacturer, and its role in U.S. national security is, well, it's virtually indispensable.
And that indispensable nature is exactly why we need to have this conversation. Because the company is currently trading around, $178 a share. And that commands a trailing price-to-earnings ratio of 53.50.
So that's the central question for any advanced investor looking at this. Is this, extremely premium valuation a true reflection of an impenetrable, growing franchise, one that's backed by a critical government monopoly validating its sort of superior status?
Or is the market simply pricing in way too much future success, way too soon, demanding really flawless execution for decades, and creating a pretty significant value trap for anyone buying in today? I'll be presenting the bear case, questioning those very rich multiples, and highlighting what I see as the political and execution risks here.
And I'll present the bull case. My thesis is centered on the competitive moat around their government operations segment and the very real optionality and funded growth catalysts that are emerging from their commercial operations. This is a rare mix of defense stability and high-growth tech. So to start, the bullish thesis really rests on the unique structure of their business, specifically that government operations segment. I mean, this is not your typical defense contracting. We're talking about a near-monopolistic position supplying naval nuclear reactors and fuel for the U.S. Naval Nuclear Propulsion Program. When you think about the life cycle of a U.S. submarine or an aircraft carrier, this company is the exclusive provider of, well, the beating heart of that vessel. The competitive moat here isn't just contractual. It's regulatory, it's technical, and it's built on a decades-long commitment to a specialized nuclear safety culture that takes generations to build. This stability, it drives highly visible, long-term revenue. And you can see that validated by a record $7.4 billion backlog. The market sees this stability, and it's rewarding what I see as superior capital allocation. We've got TTM sales growth of over 14% and really solid profitability metrics, like a return on equity of 26.69% and an ROIC of 11.21%. For a heavy industrials company, that ROE is just phenomenal. It really argues for the quality of the management team.
That stability, and I agree it's real. It just comes at an exorbitant premium. I see why you highlight the ROE, but we have to look at the price being paid for those returns. The valuation multiples, a PE of 53.50 and an enterprise value to EBITDA of almost 41 are completely astronomical. I mean, these are figures usually reserved for, hyper-growth software companies, not a complex manufacturing business. To justify these multiples, the company basically needs to execute flawlessly for years and accelerate both growth and margins, well beyond anything they've done historically. The fundamental risk for me is a structural dependence on that one client. Analysts estimate that roughly 80% of the company's revenue comes from U.S. government contracts. Now, while this guarantees a certain stability, sure, it also puts a functional ceiling on your margins. Government contracts are often structured on a cost-plus basis, or they're subject to some very aggressive repricing scrutiny. This exposes the whole company to shifting political priorities, to budget volatility, no matter how mission-critical the work is. So we're paying today for a promise of massive future cash flows that are still years away and, frankly, subject to a lot of developmental risk.
Okay, let's talk about the nature of that government mode again, because calling it a dependency, I think, misses the strategic imperative it fulfills. This is a unique strategic asset for the U.S. government, not a typical supplier you can just swap out. The technical barriers are immense. We're talking about highly complex, secure, and regulated nuclear component fabrication that requires specialized facilities, specialized security clearances. These factors ensure a stability that's far beyond what conventional defense contractors get to experience. And to protect that position, they consistently engage in lobbying. This activity, which recently included spending $150,000 in a single quarter focused on budget and defense, that's just a cost of doing business. It's necessary to maintain that legislative visibility.
This continuous engagement is a structural protection.
and it effectively insulates their revenue stream and guarantees funding for critical programs. It provides a revenue floor that most high-multiple industrial companies just can't claim.
That's an interesting point, but I'd frame that lobbying spend a little differently. To me, it's an admission that the dependency is costly. You have to spend significant capital just to maintain the status quo and try to mitigate those political risks. But more importantly, that single client dependency means any high operational and regulatory scrutiny translates directly into financial liability and margin pressure. When operations are this specialized, regulatory missteps are, well, they're inevitable and they are expensive. And we have direct evidence of this. The Nuclear Regulatory Commission, the NRC, proposed an $87,000 civil penalty against them in August of 2023 for compliance violations. Now, that figure might seem small compared to $2.5 billion in revenue, but it signals this constant oversight pressure. And then separately, they faced a much larger, a $283,000 penalty from OSHA back in 2020. These events show that their specialized nature attracts substantial legal and regulatory risk, which is a drag on efficiency that these high-growth multiples really struggle to absorb. So let's circle back to the numbers because we can't look past this stretched valuation. The enterprise value is sitting at $17.78 billion. The price-to-sales ratio is at 5.35, and the price-to-free cash flow is a very steep 35.33. Look, to demand a 35 times multiple on free cash flow means the market expects FCF generation to accelerate at a, frankly, an unsustainable pace. For a company with a gross margin of only 23.52%, I have to question the logic. If this company really has a near monopoly and the competitive advantage you claim, why isn't that pricing power reflected in a much higher gross margin? That margin profile suggests a highly scrutinized cost-plus environment, which severely limits the upside you need to justify the stock price. I'm sorry, I just don't buy that the FCF acceleration required is achievable.
I'm not convinced by that line of reasoning because you're using backward-looking data to critique a company that is being priced entirely on its forward trajectory and on the exceptional efficiency of its capital deployment. The projected EPS growth for the next 5 years is 14.66%. That's a significant figure for a company of this scale. Furthermore, the strength of the balance sheet and that return on equity of 26.69% prove that management is highly adept at taking retained earnings and invested capital and just efficiently converting them into net income. The high valuation is simply reflective of a low-risk growth profile driven by non-cyclical national security demand. That should command a premium. And we saw validation of this with the positive Q3 2025 results that topped analyst estimates and led to raised full-year guidance. The market is confirming the strength of the outlook, not just speculating. And beyond the naval business, we have to address the tangible growth from the commercial operations segment. This is crucial for de-risking the future revenue mix and justifying that multiple. And these aren't just concepts. These are funded contracts. Specifically, we have to highlight the $1.5 billion NSAA contract for the high-assay low-enriched uranium pilot plant, or HALEU. This is strategically essential. HALEU is the advanced fuel that's required by virtually all next-generation advanced and small modular reactors, SMRs. By building this plant, BWX Technologies positions itself at the critical choke point of the entire advanced reactor fuel cycle. This is a unique, funded, and high-margin opportunity. And we also have active work on microreactors for military use under Project PALEU. That's real, and it's accelerating.
That is a compelling argument on the catalysts, I'll grant you that. But have you considered the actions of those who are closest to the material? Let's talk about insider sentiment. We have observed net selling activity at these elevated prices. The CEO, Rex Giveden, for instance, he executed sales of 25,000 shares in August 2025 and another 10,000 shares in November 2025, following his option exercises. Now, while sales happen for all sorts of reasons, sustained net selling by key management at these valuation levels suggests that they might view the current stock price as fully reflective or maybe even generous for the known upside. We also need to temper the excitement around SMRs with some history. The company's own BWXT mPower SMR reactor project was terminated back in 2017. That failure really underscores the high technical and licensing hurdles in this space. Now, while component work is profitable, the timeline for any meaningful revenue from commercial SMR deployment is still, by most accounts, post-2028. So investors buying today are capitalizing cash flows that are still 5 to 7 years out and subject to all that developmental risk.
Okay, the historical context on mPower is fair, but I think it highlights the strategic transition. They've moved away from being a reactor developer to being the essential supply chain partner. And the strategic agreements, like the one for manufacturing components with Rolls-Royce SMR, that demonstrates a refined focus on their core competency, high-end, specialized nuclear manufacturing, rather than taking on the full risk of reactor design and licensing. That shift is actually de-risking the commercial segment, and I think you dismiss the insider sales a bit too quickly. In the context of their total compensation, these sales after option exercises are often pre-scheduled for tax planning. It's a tiny fraction of their overall holding. The material data, that $7.4 billion backlog, and the funded NSA HALEU contract, that speaks much louder than routine executive sales.
I disagree that they're entirely routine when you view them against the current PE ratio. When management is cashing out at over 53 times trailing earnings, it suggests they recognize the stock is trading near or at its fair value, even factoring in the potential from HALEU. And HALEU itself is a double-edged sword. Yes, it's a critical choke point, but it also ties them even more tightly to government funding and oversight, which could just compound the margin constraints we talked about, not break free of them. The gross margin for me remains the structural issue preventing them from ever justifying that 40x EV/EBITDA multiple.
The stability and cash flow of a specialized defense monopoly in naval reactors, paired with clear, funded pathways to commercial growth in essential future markets like HALEU fuel and next-gen reactor components. The high valuation is simply the justifiable price of admission for owning a highly specialized, technically moated enterprise at the absolute epicenter of the global nuclear resurgence. We're paying a premium for quality and for certainty of demand.
My final assessment really centers on the structural constraints of this business model. While this is certainly a high-quality company, the current market cap of over $16 billion demands a level of performance that is structurally very difficult for a heavy industrials company that's reliant on government appropriations to achieve. So given the substantial valuation premium, the inherent risk of government dependency limiting margin expansion, and the long timeline for SMRs, the risk-reward profile is, in my view, tilted toward the downside. The stock is priced for perfection, and until those new catalysts generate measurable, sustained margin expansion, the downside risk just outweighs the potential upside.